In the short term, market is driven by sentiment. When a company goes through growth phase, the stock can rise above the fair valuation. At the same time, when a company goes through weak phase, the stock can correct sharply even though its long-term prospects remain intact. Usually, retail investors like to chase stocks that are making new highs and avoid investing in stocks that have corrected because the sentiments are negative. But some of the biggest investment opportunities are often created when good businesses go through a temporary rough patch. Of course, here you need to separate companies that are going through temporary correction versus companies that are going through permanent disruption. And one of the way is to look at domestic institutional buying pattern, because usually DIIs try to look beyond the next 1 or 2 quarters. They try to identify businesses where the problems are temporary but the long-term opportunity remains intact. So in this video, we'll look at few such companies where stocks have corrected but DIIs are showing confidence and accumulating the fall. We'll understand why the stock is corrected and why domestic institutions have continued increasing their stake despite the weak sentiment. Please note that this is a 3-video series and this video is the part 1 of that. In this part, we'll discuss 2 pharma companies and 1 specialty chemical company where DIIs are increasing stake. I've identified more of such interesting stocks that I'll cover in the next 2 videos. But here please note that not every stock bought by DIIs turn out to be a winner. Institutions can also make mistakes, or the business can take longer than expected to revive and stock can remain under pressure for longer than you expect, and you might not have that kind of patience to hold it. So don't consider this video as a buy-sell call. Please do your research and invest only with right knowledge and once you build conviction. Also, just because DIIs have been buying these stocks does not guarantee that they will keep buying them. Institutional investors continuously evaluate their thesis, and if the facts change, they can reduce or exit their positions as well. Since Q1 earnings season has started, I think this is also a good time to keep these companies in your watch list. As results come over the next few weeks, we can actually compare the numbers with the long-term investment thesis and see whether the story is getting stronger or weaker. In fact, that's exactly what we do in our exclusive weekly video series. I closely track around 200 companies, including the management commentary, key business update, and identify investment opportunity. But this series is only for serious investors who want to learn how to analyze business and invest for long-term wealth creation, not for traders looking for quick money. For more details, you can explore the join button of this channel or you can explore my website. Alright, now let's get started with the stock picks. So first company is a specialty chemical company. It's Jubilant Ingrevia. It came into existence in 2021 when Jubilant Life Sciences was split into 2 listed companies, Jubilant Pharma and Jubilant Ingrevia. Since listing, the stock has gone through 3 distinct phases. The first phase was euphoria. Company got listed at a time when the entire specialty chemical sector was one of the market favorite theme. Investors were betting on China Plus One opportunity, global supply chain diversification, and strong demand from pharma and agrochemical company. Jubilant Ingrevia, being a leading manufacturer of pyridine and specialty chemical, benefited from this optimism and stock rallied sharply after listing. Then second phase was disappointment. From 2022 onwards, the global chemical cycle turned. Customers across Europe and US started reducing inventories after over-ordering during the COVID period. At the same time, Chinese chemical companies became increasingly aggressive on pricing. That resulted in stiff price war and lower profitability across industry. As a result, Jubilant Ingrevia's revenue growth slowed, margin came under pressure, and earnings disappointed investors. And its stock corrected significantly from its highs. But the third phase is what makes the company interesting. Despite the sharp correction, the stock has spent a long time consolidating instead of making fresh lows. Interestingly, DIIs continue to accumulate the stock every single quarter in last 3 years from 6.7% to around 24.7%. And it includes AMCs like DSP, Kotak, Bandhan and so on. Interestingly, its ace investors include Rekha Jhunjhunwala, who continue to hold stakes since many years. And total number of shareholders have also reduced from 1.91 lakh to around 1.12 lakh. Now the question is, why are DIIs buying despite the weak stock performance? Well, first reason is the Pinnacle 3-4-5 strategy and revenue pivot. Under its Pinnacle 3-4-5 strategy, Jubilant Ingrevia aims to hit a 3 times jump in revenue, 4 times jump in EBITDA by FY30. So historically, company was dependent on low margin chemical intermediate business. But now, company has done rapid expansion into fine chemical and human nutrition which moves the company up the value chain from a generic chemical supplier to a specialized partner. Then second potential reason for DIIs buying is the recovery in chemical cycle. The weakness in chemical companies was largely industry-wide due to inventory destocking, weak agrochemical demand and pricing pressure from China. So Jubilant Ingrevia fundamentals are still intact. Now if the cycle normalizes, chemical business could recover and that could provide the earning tailwind. Then third potential reason is market share gain. Management has highlighted that companies benefiting from capacity closures in Europe and is winning new businesses in several product categories. So even before the industry fully recovers, Jubilant Ingrevia could emerge with a stronger competitive position. And finally, after the correction, its price to book has fallen from peak levels to now at much comfortable levels. Now, if you observe closely, instead of PE ratio, here I am focusing more on price to book. And the reason is because earnings can be very volatile for pharma and chemical companies. During upcycle, earning growth can be multifold. And during downcycle, earnings can fall sharply and it inflate the PE ratio. In case of Jubilant Ingrevia also, it has gone through down cycle and its earnings were suppressed. At the same time, company is investing in capacity building. So today, the earnings are suppressed, but it should improve in the future as per management guidance. Hence, PE won't give a right picture. So don't blindly look at PE ratio while analyzing the company. Now, second company where DIs are showing confidence is Syngene. Syngene is India's largest contract research, development and manufacturing company. Basically, instead of developing drugs for itself, it helps global pharma and biotech companies discover new molecules, conduct research, run clinical development, and increasingly manufacture those drugs commercially. For many years, Syngene was considered one of the highest quality business in Indian pharma space. After COVID, investors became even more optimistic as global pharma companies increased outsourcing and the CRDMO theme became quite popular. As a result, Syngene's stock rallied sharply and touched an all-time high of around 950 in 2024. But over the next couple of years, sentiments changed completely. Weak biotech funding, lower demand from some key client, and concerns around earning led to sharp correction. As a result, the stock fell by more than 50% from its peak. But interestingly, DIs continue to accumulate the stock on every single quarter in last 3 years from 11% to 26%. So the obvious question is, what DIs are seeing that the market is not? I think institutions are making 4 long-term bets. So first bet is global outsourcing is shifting in India's favor. Global pharma companies are actively reducing their dependence on China. This shift accelerated rapidly with the introduction of legislative actions like the US Biosecure Act, which aims to restrict US reliance on certain Chinese biotech entities like Wuxi AppTag, which is a global competitor of Syngene. DIs view Syngene as one of the primary beneficiaries in India capable of absorbing this outsourced global research and manufacturing demand. Then second bet is Syngene is moving up the value chain. Earlier, Syngene primarily earned revenue from contract research. Today, it is evolving into a full-fledged CRAMS player, that is, contract research and manufacturing services. By adding commercial scale manufacturing capability, such as their biologics facility in Bangalore and acquisition of Stelis Biopharma facility, Syngene can now handhold a molecule from initial lab discovery all the way to commercial mass production. For institutional investors, the structural shift implies much larger order size, stickier multi-year contracts, and expanding operating margin. Then third bet is current weakness is temporary. Over the last few quarters, Syngene has faced short-term headwinds, including a temporary slowdown in funding for global biotech startup and a reduction in sales of specific animal health product. And this led to correction in stock price. However, many analysts believe that Syngene's earnings have hit their structural bottom, making the risk-reward ratio highly favorable for long-term domestic fund. And fourth reason is Syngene is a high-quality business with sticky client. So unlike generic pharma companies that constantly face pricing erosion, Syngene earns through long-term scientific partnership. Once a molecule enters development, customers rarely switch partners because of regularity, scientific and IP complexity that are involved. That gives the business much better revenue visibility. Third company in the list is Gland Pharma. Now, unlike most Indian pharma companies that primarily manufacture tablet and capsule, Gland Pharma specializes in sterile injectables. And manufacturing sterile injectables requires sophisticated technology, stringent quality standard, and regulatory approval. This makes it one of the highest entry barrier segment in pharma industry. Today, Gland exports to more than 60 countries, with US being the largest market. Company got listed in 2020 and quickly became a market favorite. However, the story changed after 2022. The acquisition of European CDMO company Cenexi turned out to be far more challenging than expected. At the same time, the generic injectable business in the US faced pricing pressure and inventory normalization. As earnings came under pressure, investor sentiment weakened and the stock corrected sharply from its peak. I remember covering Gland Pharma when it was near bottom in June 23. From June lows, stock has recovered sharply. However, it has been consolidating for almost 3 years before it has recently given a breakout. Interestingly, while the stock was correcting, domestic institutional investors were doing the exact opposite. Between 21 to 25, DIIs have consistently increased their stake in Gland Pharma from 11% to 33%. Although there was a slight reduction from September 25 high, but there is again an increase in stake in last 2 quarters. And public holding has consistently reduced. Now the question is, what are DIIs seeing that the broader market is missing? Well, first reason is Gland's leadership in sterile injectables. Unlike oral generics, sterile injectables are much harder to manufacture because of stringent manufacturing and regulatory requirement. This creates high entry barrier and limit competition and helps protect margin over the long term. DIIs heavily value this structural competitive moat. Then second reason is turnaround in Cenexi. A major drag on Gland Pharma's financials and stock price over the last couple of years was its acquisition of Cenexi, which is a European CDMO. It initially suffered from low capacity utilization and integration friction, which heavily depressed Gland's consolidated margin. However, Cenexi's operational recovery, new product launches, and successful capacity expansion in Europe have turned it from a major liability into a growth engine. I believe that DIIs have recognized this inflection point ahead of retail public. Then third reason is improving earning trajectory. After several weak quarters, company has delivered a strong recovery in both revenue growth and profitability in trailing 12 months. More importantly, operating margins have started expanding again, with latest quarter margin at 29%. This suggests that the worst may be behind the business. And final reason is the next phase of growth. Gland Pharma is aggressively playing the next decade's biggest pharma trend. Company has executed a major brownfield capex program and expanded its cartridge fill and finish capacity from 40 million unit to 140 million unit. This expansion is specifically aimed at capturing a slice of explosive global market for GLP-1 drugs and advanced delivery formats like ophthalmics. So if you conclude, the common thread across all three companies is that domestic institutions are not buying them because the last few quarters have been great. In fact, all three have gone through challenges. Instead, they seem to be looking at what these businesses could become over the next 3 to 5 years. Whether it is Jubilant Ingrevia's pinnacle strategy, Syngene's transition into a full-fledged CRDMO and global outsourcing opportunity, or Gland Pharma's Cenexi turnaround and expansion into next-generation injectables, the investment thesis is clearly forward-looking. Now, whether these bets could actually play out remains to be seen. And that's why I would encourage you to keep these companies on your watch list and closely track the result and management commentary over the next few quarters. Also, this is just part 1 of the series. I've identified several more interesting companies where DIIs have been quietly accumulating despite weak stock performance, and we'll discuss them in the upcoming videos. So that's it from my side. Now I would love to know in the comment which of these 3 companies you find most interesting. If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.